first question comes from Russ, and I think he's probably a new subscriber or new to the show. Can you explain your GIP model and how you shift your views based on the different quads?
Yeah, absolutely. So this is probably me doing too much, but I'll try to pretend to be Keith because it's
right.
really hard to show in talking. That's a very difficult thing to talk through.
Visuals are better.
Yeah, visuals are definitely better. I'm a little taller than Keith, so I want to make sure this is just a little.
Your head's not even on the screen.
I'm just a little taller than Keith. I want to make sure that I'm actually being seen. Yeah, so what we think of everything in differential terms, and what I mean by that, it's all about what's happening on the margin. Is the growth statistics or the inflation statistics accelerating or decelerating on the margin? The GIP model is a very systematic, sort of simple, well, at least we think it's simple, way to contextualize that. So you have two factors. One factor is the year-over-year rate of change in growth. That's on the y-axis. The other factor is the year-over-year rate of change in headline inflation, which is CPI, and that's on the x-axis. If growth is accelerating, it's either in one of the top two quadrants. This is quad 1, this is quad 2. Growth decelerating, it's either in the bottom two quadrants. This is quad 3, quad 4. Now, if inflation's accelerating, it's on the right side of the axis, so both growth and inflation are going up at the same time in this box. Growth's going down while inflation's going up in this box. They're both going down in this box. And this is the best quadrant for equities, which is the quadrant we continue to signal the U.S. economy will be in for the most of 2017, which is really underpinning our bullish views, not just now, but over the longer term perspective, which is why we, on any sort of air pocket type correction, we don't want to be buying and allocating to slow growth, low volatility, low beta exposures. We actually want to be using those corrections to be buying more cyclically exposed sectors such as transports, NASDAQ, industrials, consumer discretionary as well. So this is where growth accelerating, inflation is decelerating. How we think about asset allocation and rotating between those quadrants. So if you go to slide 6 in our macro deck, Josephine, or at least in the most recent macro deck, we'll have the new one out next, I want to say next Tuesday. Actually, no, is it the Tuesday? No, next Wednesday, the 11th. I don't want to misspeak. On slide 6, this table is very busy to see on the screen. This is something we can send to you, but it effectively backtests on a trailing 20-year basis all the factors, all the equity style factors and sectors, interest rates, different types of interest rates, different credit products, commodities and currencies across this 4-quadrant model. And effectively what we know from a frequentist perspective is what typically works in what quadrant and what typically does not work in a particular quadrant. So if you tell me...
If you pop that back up too, just so people know.
Yeah.
On the far left, right, the quads that correspond to the quarterly returns are the green. On the far left, you see the table, it's just green and red. Those are like the returns that are back tested.
Yes.
When you're in each quad.
Absolutely. And so now we go from there and we can see which factor exposures do the best and do the worst. And so those are the things we start with not liking on the long and short side. We like what we like on the long side, and what we don't like on the short side are the things that typically have done worse. Yeah. From there, we'll apply a Bayesian overlay to whittle down, okay, is this an appropriate investment decision to make at the current juncture? I.e., is the style factor or the asset class exposure we're signaling, actually, does Keith's model signal, does the model actually support that research view?
Yeah.
There are times when the model does not, Keith's quantitative signal does not support the research view, at which case in point we will not have a position on, or we will not have a strong bias one way or another on a particular security or asset class. But for now, U.S. equities, we're in quadrant 2. U.S. dollars should be rising in quad 2. U.S. equity should be rising in quad 2. Cyclical style factors should be rising in quad 2. And bond yields should be rising in quad 2. And all those things are actually happening like they've happened historically, and they're also happening in the marketplace. So this is something we feel like you can continue to trace and take advantage of on the long side.
Yeah, sure.
And on the short side as well.
So I think that this is just expanding on the prior question, but can you explain how you analyze a country versus a stock?
Yeah, so I mean, this is the macro show. We're the macro team. We're not doing too many single stock analysis. Yeah. The reason we analyze the economy from differential terms is because, Keith was a buy-sider. He's a former consumer PM, and this is how he was trained to analyze companies. If you think about companies that you like in the consumer space, two things you want to see is revenue growth accelerating, you want to see margins expanding. Yeah. So if you think about it from a country perspective, you want to see GDP growth accelerating, you want to see inflation coming down on the long side. in terms of your cost of goods sold, or at least a proxy for that. On the short side, you want to see revenue growth decelerating and margins are contracting. And you want to see, particularly from peak levels from peak margins, and that's where you sort of get those big moves to stocks getting cut in half and whatnot. Yeah. So we take that same framework, that same sort of bottom-up framework, and apply it to the countries using relevant country economic data. So that's definitely something that I think is really differentiated from I think how most of our competitors view the world. A lot of them view it in absolute terms, was something good or something bad. Yeah. At Hedgeye, there's no such thing as a good or bad economic statistics. It either got better or worse. Yeah. It could be really bad getting less bad, that's good. It could be really good, really great going to good, that's bad. Uh-huh. And that's the only way we think about the world.
Russ was asking, you tweeted this morning that a narrowing risk range on 10-year yields was bearish for bonds. Was that accurate? And it would seem that the risk range should be narrowing for 10-year prices as well then.
Yep. So a narrowing range when you get when a price, in this case yields, that's what I tweeted. So you get the 10-year bond yield. The risk range has basically gone from something like that, which is pretty wide, called 220 to 260, 40 basis point wide range. Let's say that's 40 basis points, the range here to here, has started to go like this. So it's like 255 to 235. So that is a narrowing range. When the range narrows, what's typically happening there is that volatility and whatever that is, this is in the case of bonds, volatility is starting to come down. And a narrowing range in the case of bonds on yields is bearish for bonds because it's bullish for yields. So again, the volatility in yields risk range is the point that we're trying to make here. As that narrows, that enhances the safety of being short bonds. And again, I think that Gunlack agrees with that. I think if you follow him closely enough, you'll see that he, like me, he changes his mind a lot. He also tweaks his levels because levels change. Why do levels change? Because price, volume, and volatility changes. This guy is a Jedi of the bond market. So again, I see what he sees, and I think that that's why he's not really trying to call for some kind of a huge meltdown in the 10-year bond yields, because guess what? The volatility in the yield, what's implied, at least looking in my model, on a realized volatility basis, you're starting to see the volatility in the yield spread narrow.
The table that you're looking at now is basically just like you can't quite see all of it just because it wouldn't have fit on the slide, but it's basically, where have we been? That's the other half of the table, but if you go back to the first half, it's kind of like, where have we been? Or, there's obviously price, but then this kind of tells you, well, what's been underneath the surface? Like price has gone from A to B, well, was it in a straight line? Was it up and down? Was it, what were these trading ranges tight? So this is basically realized volatility. So you can see there's 30, 60, 90-day realized volatility for those different tickers. And then you have implied volatility, which are those blue numbers. Implied volatility is more forward-looking. It's basically the volatility assumption that's embedded in options contracts that haven't expired yet. And then you can see what's changed with implied vol. So in typical fashion, what you see in like the S&P is that, and large premiums still exist, but what you see in the S&P is like when realized vol is in a tight range and it's moving lower, it's trending lower. Well, of course, people are, implied vol, people are going to say, well, yeah, I mean, these prevailing conditions are going to continue into the future. So it's all relative, so you look at that on a relative basis, and that's basically what we're trying to figure out. Here's where we've been, here's where the market thinks we're going.
Can you go put that implied volatility, the second one, slide up, Josephine? I just need the number. I just want to make sure I have it. Okay, so you see where this implied volatility premium is of 24.7%. You see that, S&P 500? So when I say that the S&P 500 has an implied volatility premium of 25%, which is high, very high, in other words, it means that people continue to try to position for or expect a correction. What I'm saying there is that so your duration there is 30-day, right, Ben?
Yeah, in that sense, yeah. 7.6% is 30-day.
That's your realized volatility, okay? That's realized. That's what already happened, okay? That's why we said realized. 7.6% is realized. 9.2% is implied. So implied volatility is the expectation in the options, and that equates to a plus 25% premium or discount. When you have when it's flatter, or like say 5% premium, which is really isn't much of a premium, or it's flat or even negative, a negative number would be a discount. Then there's some serious complacency in the market. So again, premiums are expecting corrections, and corrections haven't come. If you had 2 down days of 30 basis points for the S&P, or 30 to 40 basis points, I mean, I've played plenty of games on the short side of markets. That's not going to get me fed or paid. So I mean, the reality is it's been slim pickings for the bears, and that's one way to think about it. So this kind of data, we're gonna on an ongoing basis, hopefully within 3 to 5 years, I don't talk at all, and you're all very much like if you came to Hedgeye, pretty much when Ben and I are talking, it's about reconstructing how he's showing me the data, because I don't really want to read words. I want to just know where the math is. And I think that more and more of you seem to be inclined to want more and more of that, so we're going to try to keep showing it to you on a more consistent basis.